Sacco and Felice, New York and New Jersey's premier attorneys at law. Their team brings decades of experience across a wide range of practice areas. Whatever life brings, they're your legal team. From everyday matters to complex cases, they've got you covered with the experience you need and the results you want. Because when life gets complicated, they make it simple. SaccoFelice.com. SACCOFILLAS.com. 2 C's, 2 L's.
Listen, all you New Yorkers. Excuse me, taxi.
Okay, man, we're looking around.
This is the 77 WABC minicast.
So, as I mentioned at the top of the show, we got a bunch of economic numbers this week. And it really turns out that the American economy is a lot more resilient than most folks, many folks, certainly Trumpian critics would have us believe. It's Iran's economy that's going down the tubes one way or another. And the American economy is doing just fine. It can do better and probably will once we get past the temporary oil shock and the gasoline price shock and all that. But really, business is doing great. And one reason business is doing great is profits are doing great. It's a whole different model of the economy. Profits are the mother's milk of stocks and the lifeblood of the economy. You're not going to have an expanding business unless it's making money. And then it can hire people and pay wages, and that translates into family income, and that translates into consumer demand. I wish I had met Jean-Baptiste Say in the early 1800s, who said we produce to consume. And that's just what we're doing right now. Anyway, let's talk to two distinguished economists, John Carney, Breitbart news editor for economics and finance, and co-author of the daily Breitbart Business Digest, which is a must-read, and Phil Kerpin, who is president of American Commitment and principal at Unleash Prosperity, which is also a daily and a must-read. Gentlemen, welcome. John Carney, stock prices are doing very well. Right there is a tip-off that the economy's okay. If the economy weren't okay, stocks wouldn't be doing okay. So few people made that connection. And the other side of it is we're seeing pickup in manufacturing and a boom in business capital expenditures, machinery, equipment, factories, and all the rest of it. And, you know, reading the front pages, you wouldn't know that. I mean, I hate to say it, but including the Wall Street Journal front pages, the news part of the journal. So it shouldn't come as a great shock, but nonetheless, we're doing pretty darn well.
Yeah, Larry, you're absolutely right. When you look at the headlines, they're pretty gloomy. Every time a tech company lays off some people, that gets all the headlines. But in fact, what we see in weekly jobless claims is very few layoffs happening in America. And as you're saying, the stock market has had the best month in April since 2020. Basically, since we discovered that Pfizer had developed the vaccines for COVID, and stocks jumped. Well, a similar thing happened in April as investors realized that the economy wasn't going to be derailed by the Iran war, that gas prices went up, but they didn't go up to oil prices didn't go up to $150. Gas prices aren't at $6. And profits are coming in. And profits are not only fueling the stock market, but they're actually fueling this investment boom. I don't think investors would be happy with companies spending as much as they are for a lot of AI investment, for a lot of capital expenditure, if the profits weren't there, but they are. The profit growth is healthy. The outlook that we're hearing from the companies is great. This is really a booming economy despite people paying $4.30 for gas. When we bring that back down, it's going to be off to the races.
Yeah, you know, Phil Kerpin, it just is a step back for a minute. It's a different model of the economy. It's one that I've used for decades. I mean, when I say profits are the mother's milk of stocks and the lifeblood of the economy, I'm a profits-driven economist, always have been, really. It's old-fashioned business economics. People say, well, consumers do this, consumers do that, or consumers don't do this, or consumers don't do that. They're looking at it ass backwards, really. I mean, you got to start with who's making it. Are people making money? Are companies making money? And it's funny, there's a few good economies. One of them, Zed Yardeni, who follows profits very, very carefully. He's sort of a quasi-supply sider. But very few economists look at the world through the lens of profitability. And what we're seeing now is an economy, profit margins, when you look at the GDP report, are very high. Actual, forward earnings looking 15, 16, 17% in the aggregate for everything. It's not just the techie companies, Phil. And what's to stop that? And the one big beautiful bill, of course, gave everyone a leg up with the 100% depreciation bonus, the immediate cost expensing, which is helping to promote. It's like a subterranean boom that's going on, Phil Kerpin. Maybe that's the best way to look at it.
Yeah, I think it's pretty incredible what we're seeing right now in terms of business investment, and especially the equipment component of business investment. If you saw that was up 17%, I believe, in the first quarter.
Yep.
And that is driven enormously by exactly what you just said. We said, look, all your equipment purchases, you're going to be able to write them off immediately. And now the other thing that's really positive, what happened in the big beautiful bill, is it's not one of these, you have it for a couple of years and then maybe it's gone and you got to lobby and you're not sure what it's going to look like. Now you can pencil out all the investments you plan to make and know that they're going to be 100% expense the year that you make them, because that's now a permanent feature of U.S. law. So I think that's enormously positive. The only weak area really in terms of investment is that we didn't see good numbers in structures or in homes, in residences. But everything else on the business side looked fantastic. And you're exactly right. That is the much better indicator of where we're headed in the future than what the consumer's doing. Because if we're more productive and we're producing more, then incomes are going to rise, standard of living is going to rise.
Phil, why is housing still in the dumpster?
Yeah, I don't know. We've got a lot of negative sentiment, I think, that is kind of keeping housing down, and we've got a lot of bad policies in a lot of places also. If you look in Texas, where you've got really good policies and the market is able to meet the demand, I just saw some incredible charts the other day. All the rental markets in Texas are now back near all-time lows in inflation-adjusted rents as a percentage of income, because they've had huge building. They've had a lot of build to rent. One of the problems we've got nationally is you've got very little build to rent, and we disincentivized it further because they keep in Congress talking about banning build to rent. So who's going to construct a big project if you might be prohibited from renting it? And so I think we've got a lot of bad policies, state and local, and maybe some bad policies coming federal, or the threat perception of them anyway.
Would it help, just on this point, John Carney, I'm coming back to you in a minute, but Phil, if we inflation indexed capital gains, which is something that we've talked about doing for a long time, but we never seem to do. We've inflation indexed the income tax code, but not the capital gains. Would that induce more selling because it wouldn't pay so much? It wouldn't pay the cap gains tax on inflation. We'd just pay it on the real gain. Would that put more homes on the market? Would that do it?
Well, I think it would certainly help. We would unlock a lot of assets that are just being held because of because of how bad the tax bite is. And of course, every capital gains cut we've ever had, Larry, has increased revenues because we unlock every single one. And so this would, I think, be a very smart way to do it rather than just cutting the rate again. Let's say we're not going to tax the inflationary component, and I think that would unlock a lot of assets, not just homes, but a lot of other assets that are being held just because of that tax. And I think the reason there's so much momentum behind doing this now, and we've been talking about it for decades, but the reason there's so much momentum now is every single asset in the economy has this big inflation component in it because of what we just had under Biden. And so, say we're not going to tax all of those assets, it becomes much more likely that they'll be sold. Now, I don't know we can get the votes to do it, and I don't know if Trump's going to try to do it by executive means, but at a minimum, what Congress should do is say we're going to increase the $500,000 exemption for primary residences, and there's actually a bill to double that and inflation index it going forward that has a lot of Democrat support. So that one could be bipartisan.
Whose bill is it? I was not aware of that. Whose bill is that? Do you know?
I think that it's Cornyn in the Senate, and the House is a Democrat. The name escapes me, but it's pretty bipartisan.
All right. So, John Carney, the other another big piece of news. No, the Fed didn't move, but Jay Powell's not moving either. Okay, so I keep pushing. All right, fine. He wants to be chairman for life. It's the last thing Kevin Warsh really needs. By the way, it stops Trump from appointing, a fourth reformer to the Fed. I mean, he's going to take up a seat, which is most unfortunate. But, I'm only half joking when I say that we should take away his parking spot. That'll do it.
I think it would help a lot. You can also put his office wherever you want. So, it would be very funny to put him in the construction site so that, the jackhammers are going. Look, I actually think that there's a connection here between what you guys were just talking about. Usually when interest rates go down, it actually tends to push up home prices, so it doesn't do a lot for affordability. I don't think that will happen this time because of the interest rate lock-in effect. When interest rates come down, it's actually going to free up a lot of people who are sitting on houses that they do not necessarily need right now, but they're unwilling to trade into a 6.5% mortgage when they have a 3.5% mortgage. You lower that differential a bit, and you will get more homes selling, which will help with affordability. And actually, I think it will help prompt home builders to do more work. It's ironic that home builders aren't building more when we don't have a lot of existing homes on the market. But I think they look out and they just don't see a lot of home buying at all, and that makes them hesitant and worried. I think lower interest rates will actually help bring more new homes onto the market because they'll see more older homes coming onto the market and being sold quickly.
So what do you make of this? You had 3 dissents at the last meeting on the basis that they didn't want any hint of easing in the Federal Reserve statement. And then you and I talked about this on the TV show. I couldn't find any hint of easing. I mean, what's going on here? Is this some kind of anti-Warsh cabal that's happening? Plus, you have the fact that Jay Powell doesn't want to leave, which means President Trump can't appoint another person. In other words, as I understand it, so normally Warsh would take Powell's seat because Powell would be a gentleman and would leave the way every Fed chairman except one in 113 years has left. And that would give Trump, then you have the Steve Myron seat, either keep Myron or appoint someone in that spot. So he'd have 4 Trumpian reformers on the Fed. Now, do these Reserve Bank presidents, are they trying to stir the pot here? Are they in cahoots with Powell, who's going to keep Trump's seat off? Or what's going on? How do you read this?
That's right. They are in cahoots with Powell. I actually, I think if Powell could have dissented from his own statement, he would have. These guys are, in fact, doing what Powell wanted them to do, which is to tell Kevin Warsh, we're going to make this difficult for you. I think it was inappropriate for them to do it. As you said, there's not easing language in this statement at all. If it is, it was written in lemon and you have to hold it above a candle to make it come out. It just doesn't make any sense. The statement they're objecting to is something that's been there for a long time, that says we will pay attention to both sides of our mandate, and if something changes, we'll change policy. That's not dovish or hawkish. They didn't want it there because what they wanted was a statement saying we may be raising rates. I mean, it's hard to interpret that except as an attempt to scare the market. I mean, frankly, to bully Kevin Warsh even before he gets in. I don't think and it's very unique. I've never seen 3 presidents decide to dissent not from the policy itself, but from the way the policy was described. I think it's very political.
What is it, Phil Kerpin, on the inflation front, we had some lousy inflation numbers that came out with the GDP report. And let me look at the income statement. So the core PCE deflator up 0.3%, 4.4% the last 3 months at an annual rate, 3.2% over the past 12 months. What do you make of that, Phil Kerpin? Let me start with that.
Well, I think this relates directly to what's going on at the Fed. They have quietly started expanding the balance sheet again, so we're in sort of a QE light kind of mode. The money supply has been expanding again, and we don't have much discipline on federal spending, despite a lot of the hue and cry about supposed Republican cuts and so forth. I think the outlook for federal spending is very high because we're going to have this unpaid for war supplemental. And so we've got the purchasing power of the dollar weakening and shows up in the inflation numbers. It's not great. What's
the money supply? I thought it was only about 3.5% last 12 months.
Well, that would be equal to the PCE number of 3.5. So.
The 2%. Oh, okay. I got you. So Kevin Warsh wants to expand the inflation definition or the inflation measures. And I went back and looked, John Carney, let's see, the Cleveland Fed median, which I think you like, 2.7% on the CPI. So at least it's not 4.5%. The trimmed mean at 2.6. The Dallas Fed's trimmed mean is 2.4. So those are better numbers than the PCE deflator numbers. John Carney, I was going to ask you before we had to stop out: you think the inflation rate is as much of a threat as Phil does?
So I think the headlines are going to be bad as long as the price of gasoline is through the roof. But I'm not that worried about it. I actually think that the AI is going to be deflationary, not inflationary. And when I look at these underlying numbers, the median and the trimmed mean numbers, those really tell me where the inflationary impulse is in the economy, and it's not very high, and it actually has come down a lot. So I try to look past the headline numbers. I'm critical of people who take cherry-picked indexes. What I like about the trimmed mean and the median numbers is that they keep you honest. They are what they are. You didn't carve out things you don't think are important. It's just exactly what, the center of inflation. And so I'm not as worried, I guess, as Phil.
But the likelihood is you're not going to get any Fed rate cuts for a while, at least until the war is over, and then we'll have a look and see when gasoline prices come back down.
That's right. No, there won't be any rate cuts. First of all, Kevin Warsh needs the committee to come along with him. It will take a little time for that to happen. He's not going to push for a cut in the first meetings no matter what.
I think so. I think that's right. Well, Jay Powell, I don't know. You may lose your parking spot. We'll see how that plays out. John Carney of Breitbart, Phil Kerpin of Unleashed Prosperity. Appreciate both of you. Folks, we're going to take a break. And Mark Thiessen, columnist for the Washington Post, and he's got some interesting thoughts on the war. Do we need a deal or not? I'm Kudlow. We'll be right back. Stay with us, folks.
The Marine Toys for Tots foster care program is bringing hope to children who need it most. Every 2 minutes, a child enters foster care, often with only a small bag of belongings. More than 400,000 children face trauma and uncertainty, many before age 8. This May, during Foster Care Awareness Month, Toys for Tots is creating Room for Joy. In 2025, nearly 375,000 children received comfort through toys, books, and essentials, reminding them they are not alone. Donate now and change a child's life.